Sup?
We are live. How's it going, man? I literally started it up right when you were joining.
There we go. All right, man.
By the way, your microphone is on the other side.
Okay, let me fix that. Hold on 1 second.
My daughter's saying goodnight to me. How's it going, everyone? Just getting ready here, but let's get comfortable tonight, right? We're gonna get pretty deep into macro today. Good night. We're gonna get pretty.
How's the sound now?
It's still coming from your
camera.
Whatever it is. So we're gonna get pretty deep into macro today. I think probably a little bit less micro, a little bit more macro today. We're gonna cover a lot of aspects today, and it's gonna be kind of like free flow. So we have a loose agenda. We're gonna kind of obviously go over the markets. We're gonna talk about the treasuries, what the bond market's saying, what credit spreads are saying too. I saw you post about that one today, Kris. That was actually very interesting. And the fourth turning. I think I brought the fourth turning stuff up probably like a few months ago. But of course, 2024 Sammy didn't think it was going to get to that level, but now it's actually starting to make a little bit more sense. But in that case, I'm not trying to spread FUD. We're just trying to take in viewpoints and perspectives from all around, right? As an investor, you need to understand all sides. You can't be ignorant from certain sides of the equation. You need to understand that the bear case, you need to understand the bull case, and you need to understand the other possibilities that could actually happen and not be blind to it. Because otherwise you don't even ever want to be like that, to be honest. So it sounds good out, actually.
This is something that I've been thinking about over the last 24 hours. You ever met a politician that didn't break shit? You know what I mean?
They all have broken stuff, but not to this degree and intensity.
No. I'm saying like every single politician, even when things are good, they're like, let's fuck something up, because this way they can create a legacy behind it. And it always tends to be something that the previous guy did that messed things up, or maybe even something that the four presidents ago did. So here's an example. You look at the subprime crisis. What was the root cause of the subprime crisis? It's this whole notion that everyone should own a house, right? Like that was the equation. So what happened? Everyone did own a house. A lot of people owned it fraudulently, and boom, we got the subprime crisis in 2008. Then you have let's get everyone to go to college, which is a good idea until all these people started to go to college and ended up getting a whole bunch of, student loans that they couldn't afford, right? And then now you got a problem with that. Then you had, hey, we should just, do a whole bunch of free trade agreements with everyone, let the Chinese into the World Trade Organization, all that stuff. And now we hollowed out our manufacturing base, and here we are like, oh, we need to get our jobs back. And it's like, can y'all stop breaking shit? Like, it just feels like every time these guys come in, it's like, let's craft a policy that we can use to cement a legacy. And then that legacy ends up looking nice on paper for a little while, because it's like all the acts that they come up with look like good things on paper, but they end up screwing us over. Like, here's a question. Like the thing that we're dealing with right now is the Inflation Reduction Act, which caused inflation, Then you had all the CHIPS Act and all this other shit. So it's just, stop rescuing us. You know what I mean? I just want to be like, the government needs to be, there needs to be a response, but just a measured response. Stop going fucking absolutely crazy with your shit. So like right now, the example that I would give is, I agree with certain level of tariffs. I think if you put on a certain amount of tariffs, the market can absorb it, and basically we can move on from it, right? But that's not what happened. We got freaking 40% tariffs on most of the countries, and it's not even based on any real number, So
not yet, though. Not yet. We don't know for sure yet. So,
Yeah.
there's already negotiations being in place, Vietnam, Argentina, and probably a lot more to come the next few days. The tariffs are coming on. The baseline tariffs coming on April 9. He's already opened negotiation with Xi Jinping, but seeing the reciprocal tariffs that came in very early in the morning or daytime during China time, it doesn't really seem like there's going to be much negotiation anytime soon with the reciprocity. Is that a word? Coming on.
Yeah.
But no, I mean, I agree with you. Like every president they're not trying to, I don't want to say break something, because I feel like ever since they stopped pegging the US dollar to gold, it's pretty much just been like, let's just print money to infinitum. Let's just keep issuing debt. Obviously, like, the country's premise has been built on debt since the beginning, but the degree and intensity of it since since not pegging the dollar to the gold has just been to a crazy amount. I mean, to be honest, if you think about COVID, right? COVID was not like the beginning of quantitative easing. It wasn't the beginning of 0% interest rates. Really, the time when like they really practiced quantitative easing was 2008. They did some form of it before that, but 2008. Who was that? Was it Bernanke? 2008.
Yeah, it was Bernanke.
Yeah.
Bernanke.
So 2008, they had to put interest rates. Was it 0% or was it like near zero or something? But
near zero. Well, it was 0%. What happened
0%?
was,
Yeah.
so I mean, let's just. I think this is always important to understand like the Fed funds rate and see how things kind of get manipulated. And each one it's a crisis on itself. So this is the Fed funds rate. Okay, this is what basically the Federal Reserve uses as basically their think of what is that thing called? Think of like it's like a switch, right? Every time something happens, they move it up and down. This way they're able to kind of control things. So usually what happens is when things become too tight, which means that people are, struggling, what they do is they inject liquidity into the markets, and then they also at the same time lower interest rates. When things become too light and growth is too crazy and inflation start to rise, they go the opposite direction, which they put pressure on the market. So essentially they control the gravity of the markets. Okay. So if you look at how the federal funds rate is, I mean, and I'm not going to go to like all the way into the 80s again, because it's really like not that necessary. We can go like probably into like the 90s and forward. Right. So if you look at like 1980s, we had high inflation from the Jimmy Carter thing with the oil crisis. So after that, Paul Volcker comes in, raises the federal funds rate like to crazy levels. And literally that helps. Yeah, because he had to control inflation.
Yeah.
Right. So inflation was, let me add inflation on here because I think that'll help too.
See, that's the thing. Like people compare to 1970s, like we're not there. Like this is not the 1970s situation. And the Fed's hands are really tied. Did you listen to Jerome Powell's speech today, or what was that, kind of like an interview sort of Q&A? Yeah. He basically said, "Hey, look, the job market is fine. Inflation, he didn't say transitory this time, like the FOMC meeting, but he basically said inflation it's high right now, or it's sticky right now, and they're going to take their time, and they don't see their need to act soon." And I see this chart you're putting up here. It kind of moves around the inflation, right?
Yeah. So basically, the Fed funds rate, they utilize the Fed funds rate to make sure inflation doesn't go absolutely insane. Because when inflation starts to go crazy, what tends to happen is people, the expectation that future inflation is going to come. And so they end up buying more stuff. And the thing is, if they have the credit to do it, then inflation will keep going higher and higher and higher. And then we'll have Weimar Republic status. So what the Fed does essentially is start to raise interest rates so that the cost to borrow goes up. Right. And if the cost of borrow goes up, that means less people are going to be willing to borrow money. Right. So you can see here in the 80s, they had massive inflation And so Paul Volcker had to go absolutely insane and raise interest rates to levels that were never seen before in the United States. So you're talking about like 18, 20% interest rates, which is absolutely insane, but that is what he had to do. And he ended up getting a lot of hate. A lot of people came after him, but he stood his ground. You know, he did what he had to do. And eventually inflation came down. Now, what did this do? This created a system whereby when inflation rages, you kind of like lower interest rates. But then what we saw was a phenomenon with NAFTA and technology. So these two things really accelerated, well, technically it decelerated inflation. By being able to produce goods outside the country, which is globalization, you were able to lower the cost of those goods, right? So that is very deflationary. So what happened is after like 1997, you can see that inflation actually came down and stayed at a muted pace, which is about that 2%. But then on top of it, when you layer on technology, you get a huge productivity boost from technology advancements, and that the cost of labor stays relatively the same. So if you get that, you get more deflation. Right now, we could be entering into a super cycle of deflation again because of two separate things. One, we have an aging population, which means our worker productivity is naturally going to be kind of like going in reverse. But at the same time, you have AI, which is increasing productivity. And then on the other hand, you got demographics where the people are not having as many children, right? Which means you're getting deflation there because the amount of demand for goods and services is going to go down. So as the population shrinks, or at least the growth rate of the population moderates to a very small amount, which is another chart we can put up, you're going to get deflation eventually. Right now, we've got some inflation, but I think it's, and I hate to say the word transitory, but it's transitory. It was actually caused by some extraordinary like circumstances from the Russia-Ukraine situation where natural gas prices went up. So one of the major inputs, costs to production, went up. And then on top of it, we had all the stimulus spending from the COVID era that ended up going into the pockets of people. And then you had like a mortgage market that had gone to like sub-3 mortgages. So everyone was able to refinance lower. And basically all that additional mortgage savings went back to the bottom lines of the consumer, which meant the consumer had excess disposable income to go out there and spend. So the amount of stimulus that came out over the last few years was rather strong. And now what we're seeing is the hangover because we're trying to get inflation to come down. And it's staying at a point where the Fed does not feel comfortable letting it linger. You know?
Yeah, I mean, I think this is actually more attributed to the early 1990s, the situation. If you zoom into the early 1990s, damn, man, you became a pro at this. You've been like knee deep in these Fred charts lately, haven't you?
Yeah.
The last time I remember like a couple months ago when you were bringing this up, it's like, oh, I gotta click this. Now you're like, you're what's his name? What's the name of that real estate guy?
Half my Twitter feed is basically Fred websites.
They're good. They're good.
Trying
not
to
many people use them. This is legit data. This isn't just some like Twitter image that someone took and then reposted or whatever. Like this is like legit data, and it's great. But if we look at the early 90s, look how inflation was coming down from the late 1980s when Volcker finally destroyed inflation. And you had a little bit of bounce there. And during that time period, if you look at the green line, that's the CPI. And then you look at the blue line, and that's Fed rates, right?
Mm-hmm.
Kind of went stagnant there for a little bit. And inflation was a little bit sticky. And look where inflation is over there. It's at 3%. Look where interest rates are. It's a little bit higher than 3%, but the market's price.
It's almost 6%. It's almost 6%.
No, I'm talking about like 1992, right? Because I'm attributing this to like 1992.
Sorry.
1992 was like, people thought we were going to have a double dip recession. They thought that this was like when tech was like starting to come, right? But then it was like this massive dip in the market because it was a scare of a recession. There was a growth slowdown. It's like a very similar scenario to today. That time it was Clinton that just came into office. things were changing, right? And then the Gulf War started, and that kind of triggered everything, right? It kind of made everything a bit scary. So during that time period, inflation was kind of coming back. The Fed couldn't really do anything. And so you even see it in that chart over there, right? That there was a recession scare and a growth slowdown, but no cuts, no emergency cuts, right? We might be in that scenario. Can you overlay the 10-year on this chart as well? Is there where you can do that?
Yeah.
Okay, that would be cool because I kind of want to go over the 10-year as well. It's a very interesting scenario because it wasn't like not more than just a couple of years ago people thought we were in 1970s, and then it's like guys, we're not in an exact period, but things certainly rhyme. But let's be honest, inflation is not coming back. Like this is the housing market is just dead right now. There's very little inventory and there's very little demand, and people don't want to sell their homes, right? And people that are selling their homes are leaving their homes on the market for a long period of time. If you open up like Redfin or Zillow, like the average listing is listed for like 60 days or longer in LA. Like I haven't seen this in a long time. All right, so we got the 10-year over here. Oh, that only goes to
it only goes to
there.
this.
Interesting. Okay, let me actually see if I can pull.
Actually, no, this one's on the inflation index. Maybe I've got the wrong one. So let me just modify this.
What's going on in the chat, people? Mad Money ETF. What's going on? June, Derpy Rock, Ray. What's going on? Vix, how's it going? Big Billy, Ryan Rip, welcome. ND, it's good seeing you, dude. Ahad. And we got a lot of people on Twitter as well. So thank you for tuning in, guys. Hey, Kris, don't forget to put it on your Twitter, by the way.
I can't do it right this second, only because I'm logged in. So it's fine.
Okay. All right. So anyways, let me actually hide that chat. So, oh, you still bring it up. So
interest rate, yeah. Sorry, go ahead.
That's kind of what happened in the 1990s, right? And what happened right after that? We had the huge dot-com bubble. And personally, I think that if this AI wave does come, that could possibly happen. I don't think we were in a bubble. I think things got a little bit extended. And I think the rush for the exit right now is pretty quick because there's a lot of uncertainty in the market. But have we seen a massive growth slowdown yet other than speculation or Atlanta GDP forecasts? We haven't. So, you know, at the same time, like we could certainly go lower. But there's a lot of FUD out there. So for me, you know, I'm not going to say that we're going to be in a recession. I think we might be in a recession. I mean, JP Morgan certainly thinks we're going to be in a recession. All right, so cool. So we got the 10-year over here. The 10-year was
okay. Here we go. So which period do you want me to zoom into?
1990s. Go to like 1990 to
2000.
Yeah, 2000. Okay, so the 10-year over there is right. Yeah, look, the 10 years. Well, we're coming from the 1970s, so obviously it's much higher, especially with like 15% mortgage rates. But you can see the 10 years like slowly creeping down, right? I think this is very similar to what we're going to see. The 10-year is coming down, but at the same time, you know, we didn't have a degree of inversion like we did before. But at the same time, you're seeing the 10-year starting to creep down. You're seeing inflation remain a little bit sticky, and you're seeing the Fed basically not do anything with rates for 2 years about, right? So we might be there. I personally think the Fed is going to cut. I think they're going to be forced to cut at a certain point because the bond market just pricing it in so much. Over here, this spread between inflation, or what would that be? Real rates is the spread is massive. It's like 3 or 4 percentage points, right? Today, we have maybe like a 100 basis point spread. 10 years at 4%. Inflation is like around 2.8% or 3% or something like that. So there's a little bit of room here, but at a certain point, the Fed is going to be forced to cut. Not because of the fact that they're going to be cutting out of scare, whatever, but they're going to be forced to cut only because they're going to start foreseeing some data and slowdown and so on. Because we're going to get a slowdown, but maybe not to a massive degree of a depression. But I definitely think we're heading toward definitely an actual slowdown. And in Amit's live stream, he asked Matt, what do you see happening? And I think correct me if I'm wrong, Matt, because you're in the chat. He thinks we might have a Biden recession. So basically 2 quarters of contracting GDP. We're probably going to have 1 quarter contracting GDP for sure. We're going to have 2 quarters. Well, then that would signify a technical recession by any means, but it's possible we could be there. We could be in the 1990s. And, we'll see what happens. I actually wanted to bring up a Twitter thread that I saw online that's actually pretty interesting to read about. But you got anything to say? Oh, you're on mute.
I'm not in the 100% on the recession camp just yet, mainly because I kind of see some of the positivity that could be coming in the next few weeks. And the thing is, the consumer still remains very strong. Okay, like the jobs are good. Like even today, like me and the wife were out. People are spending money. They've got the cash flow to do it. If private credit steps in, that there's no need for us to go into a recession. Could some of the impacts of this trade war have short-term negative impacts? Yeah, absolutely. But in terms of people spending money, like the consumer is relatively strong. They're doing what they're supposed to be doing. If the job market was collapsing, I'd be a little bit more concerned. I know a lot of people will have like this reduction in jobs from like government cuts, like government job losses. But I think the private market has enough latitude to absorb majority of them. The challenge that I have when it comes to a recession that actually supports the recession is that you're seeing the government kind of pull back on spending, which means that the private markets have to step up to do it. So right now, I think the Trump administration is trying to do that also, which is trying to get more deregulation into the private sector so that you have more private sector investment to make up for the government spending shortfalls. The one thing I just want to highlight, and just to basically help people understand, we're in a zone where the Trump administration is trying to basically correct the ship before it goes into crash mode. Okay. And they did it preemptively, which you got to give Scott Bassett and some of these guys a little bit of credit that they're willing to spend the political capital in order to get things under control. Now, what do I mean by that? So one of the charts that's very interesting to see is actually this federal, let me just bring it up, outlays to interest. Okay, so if you see this should be a very big concern to everyone here in the country. Okay, our interest rates, because we've been able to kind of keep interest rates under control and bringing them down, are the cost to us as a country for our outlays has actually been somewhat flat. So in 1996, we were paying $241 billion in interest. Okay. In 2015, we were paying $220 billion in interest, even though our debt went up significantly. Why? Well, the reason why is because we were issuing debt at 6-7% in 1996. And then 20 years later, we were issuing debt at 2% and 3%, right? So even though our national debt went up significantly, we were able to manage our outlays because of the interest rates. But this whole inflation scare made the Federal Reserve raise interest rates. And now we have to recycle all of that debt. And now look at our outlays. Our outlays jumped from that 200 in 2016 to all this additional spending to now almost 800 something. It's actually even higher than this because this is this is backward looking. Let me just pull up right here. In the 1990s, because of the high interest rates, we were paying 3.1% of our GDP as interest. You see how things went down, things went good for America. Now we're back to almost 3% again. So
This is
we're
why
just
I think we're in the 1990s.
yeah, so this is exactly, and you're exactly right. This is why we need to take control before this thing turns from 3% of our GDP to 5 to 6 to 10, and then we'll never be able to recover. So we've never been paying as much interest as we're paying right now as on our on the GDP basis. So one of the things that we definitely need is we need the Federal Reserve to kind of come in, lower interest rates, and then also control our debt so that it does not grow as fast as it's been growing. Because if we don't control that, then this could literally set us up for decades, if not a total collapse of the country. And I think the current administration, they understand that, and they're making all the necessary moves in order to get us back from the brink, which is this 3%, back to probably not the ones again, but probably somewhere closer to 2%, 2% of GDP. Yeah.
So I want to go over this tweet real quick, and let's see here. All right, hold on. Gotta close up that tab. Gotta close that tab. All right, so right here, this is a pretty interesting tweet or thread per se. All right, let me just zoom in more. Close that guy. Okay, so Trump's new tariffs aren't a trade tweak. They're the first move in a full spectrum reset. 9.2 trillion in debt matures in 2025. Inflation lingers. The lines are shifting. One announcement. Okay, so this is kind of what I'm saying, what I'm thinking right now. And I think you're thinking the same thing too when you're talking about interest debt. They have to make sure the 10 years lower because the TGA or the Treasury, the TGA or the Treasury's checkings account, basically, they're going to have to fill that thing up, right? Right now, they're just draining all the funds that are inside there. I think they got like a month or two left or something. When that debt ceiling talk comes in, they're going to have to refill that Treasury general account. And when they do that, they're going to issue a ton of debt. And Scott Bessent has said many times he wants to issue debt from the long end of the curve. So what's been coming down lately? The 10 years down about 80 basis points since the other month, and it's still continuing to go down. Jerome Powell is holding his stance today, but this is why I think he's going to be forced to cut. He's going to be forced to cut because he does not want there to be inversion again. The amount of signaling there would be if there was inversion again would be catastrophic. But on top of that, it would not put him in a good place in terms of interest rates. But anyways, let me continue. Okay. Start with the 9.2 trillion must be refinanced in 2025. If we rolled into 10-year bonds, every 1 basis point drop in rates saves approximately $1 billion a year. So a 50 basis point drop would save about $500 billion over a decade. Lower yields free up fiscal room. Without them, core spending gets crowded. This is kind of the same chart that you were just showing us, right? This is the debt distribution, basically debt, right, in the US. And this is just distributed across. But this is what this person forecasted to be, assuming that the debt gets refinanced at whatever lower rate there might be, right? So does this not look like the chart you just showed us that they expected to come back down? This looks like the 1990s, dude. So how to push yields down with sticky inflation and cautious Fed. Manufacture uncertainty. Sweep in with tariffs, spook the markets, trigger risk off, money exits stocks, floods into long-term treasuries, a deliberate detox to cool the economy and cut refinancing. All right, this is obviously not coincidental that she's saying the word detox because Bessent's been using that term for quite some time. He actually gave a fair warning about that in early May, but the market did not believe him, right? And there's actually a fact check on here, and we'll get to it in the next one, right? But you could see, like I said, the 10-year went from 4.8 all the way down to, I don't know when they took, here, yeah, right, 4.05, but I think it's at 4% today. Cheap refinancing isn't enough on its own. Even at lower rates, the debt remains enormous. That's where the next lever comes in cutting deficit. Elon Musk and Doge are cutting $4 billion per day. At that pace, they'd shave off $1 trillion by the end of September 2025. And there was a fact check here from Grok. Basically, or I don't know if this is Grok, whatever, but It's actually closer to $2 billion a day. I don't know if that's factual. I haven't double checked the data, but even if it's $2 billion a day, 356 days in an entire year, that's about $700 billion. That's still a good amount of money. All right. With these savings, a big economic pillar to successfully deliver on Scott Bessen's 3-3-3 plan is to get growth up. So the 3-3-3 plan is 3% GDP, 3% debt to GDP ratio, and then I think $3 million barrels of oil delivered per day. But here's the problem: American factories can't scale up overnight. In the short
3
term,
billion additional barrels per day. Additional.
Oh, you are correct, sir. Matt's probably like cursing under his breath right now. Apologies. But here's the problem. American factories can't scale up overnight. So in the short term, consumers will face higher prices. The administration knows this. That's why they're front loading the pain now, betting that 2026, the benefits will be viable. In the meantime, they're offering near-term relief. Tax cuts have already been floated to help offset the cost of burden to households. And while risky currency devaluation may follow later to make imports cheaper without tariffs. Don't forget, tariffs also bring in revenue. Estimates suggest that they could raise over $700 billion within the first year. That's not a game changer on its own, but it gives the Treasury a bit more room to maneuver. Okay? Still, this approach isn't without risk. If domestic supply chains catch up or if global retaliation kicks in, inflation could rise again. If that happens, the Fed may be forced to raise rates, which will blow a hole in the low yield plan. So for pretty much the rest of this, she talks about the risk of this entire plan and how aggressive it is and how this might backfire on them, because if the Fed is forced to increase interest rates, it kind of blows the whole thing out of the water, because then now we're stuck in this higher interest rate environment, and then the government's got to be forced to issue debt at a much higher interest rate, and then the plan pretty much just goes into the hole. I'll actually share this tweet in the chat for you guys. So what do you think about that? Can you hear me?
Yeah, I can hear you. Sorry. I was looking at Matt's comments. It's not 3 billion barrels. It's 3 million barrels per day additional, because we already do like US.
Wait, did I say 3 billion? My bad.
Yeah.
I did mean 3 million.
Yeah, we do right now. We're literally the largest producer. So we do about 13 billion barrels per day. And the thing is, I think he also meant to include natural gas in that also. So barrels of oil equivalent. So Kris said billion. Sam said
what's the
billion.
difference between a billion and a million, man? That's like,
it's a big
no
difference.
difference.
But you're right. I'm sorry.
There's no
Matt.
difference.
Sorry.
Yeah.
Yeah. So
correcting us.
it's 3 million barrels additional, 3 million barrels. The problem is you can't have them produce that additional those additional barrels, because the break even costs are right now like close to $60, and the price of WTI is down to $60. So the Permian Basin, they're not going to drill more.
They're not going to drill more with the oil down. Yeah.
And the thing is, OPEC right now is adding additional supply into the market. The good thing is that as OPEC adds more supply, the price of oil comes down, which then filters back into deflation for us. I mean, disinflation for us, because that means that commodity prices will go down. And commodity prices go down, that means that all the costs associated with transportation, production, they start to go down as well. So, this is a, believe it or not, a good thing. The only thing is U.S. oil producers are going to suffer from this. So,
yeah. And the thing that has me, I don't want to say worried, because I mean, it is what it is, but more like the thing that is like very catchy about this is this isn't something that, even if, let's say, Trump decides the next couple of weeks, like, okay, let's just say it is what Matt said, that the tariffs is only be half of what is proposed, right? The amount of uncertainty that brings for chief executives in companies and CIOs, CTOs, COOs, whatever, they don't know what they're going to guide. So they could very easily just not guide altogether. And I know Google does give guidance, but other companies do give guidance. And if they don't guide, that is almost as bad as, that's actually a little bit worse than guiding lower, because now you're bringing in more uncertainty. And because the market hates that, we could probably see another bad earnings season. I would say last earnings season wasn't that great. Another bad earnings season would bring us a little bit lower. I don't know where we're going to be when we enter that earnings season, which is like in a couple of weeks. But I mean, the market's setting up for that. That's basically
I think it depends on the companies themselves, right? The reason why
I know, but go ahead.
The reason why I say that is because not everyone is impacted by the tariffs nearly as much, right? They're going to basically be looking at the consumer. If they're a consumer-focused company, they're going to be focused on that. They're going to say, look, we see consumers strong. They're doing their thing. They're spending. They're not going to say our input costs. I mean, unless you work in an industry where that's specifically something that is going to impact you, then that's something that you could talk about. Like, so an example, cruise lines, they're not impacted by the tariffs as much, because most of their inputs don't come from actually finished goods that get delivered to them. So there's no margin that they have to play around with. If anything, the price of oil coming down is a boost for them because their earnings are going to go up because the cost of fuel is coming down and actually stabilizing. So last year, bunker rates were like $70, $80 a barrel. Right now they're 60. So it kind of helps them. So I think what it is we have to keep things into perspective. Each business is going to have different comments that they're going to be making. Like the challenge when you're right that the Mag 7 are going to end up facing is that there could be retaliatory tariffs that go after digital services. That's where something that I'm sure the analysts are going to be asking them, like, hey, if France or Germany goes ahead with retaliatory tariffs on digital services, do you guys have you factored that into your earnings? That's something to be concerned about, which is why the Mag 7, which has a lot more international exposure, is taking a bit of a beating right now. So if your business is primarily situated in the US, you can guide pretty clearly. It's just the Mag 7 guys that are going to be stuck. I'll answer Christian's thing real quick. What's the difference between disinflation and deflation?
Yeah, I was just going to type that up.
If let's say you have a product that cost $1, okay, next year it goes to $1 and 2 cents. You got 2% inflation, which is fine. That's like growth, right? You want to see the thing grow over time. So that's inflation. Let's say the year after that, instead of it going up by 2%, it only goes up by 1%. That's disinflation, right? It's not that inflation went down. It just meant that it just went up by 1%. So that $1.02 thing, instead of it going up by $1.02, going up by another 2 cents, which would make it $1.04. Now it's only, let's say, $1.03. So the amount of inflation that was in the past was 2%. Now it's only 1%. So that's disinflation. Deflation is it went from $1.02, and then the year after that, it went for $1. That's deflation. Okay. And deflation is not good because what ends up happening is if you think of something on an aggregate basis, we have hundreds of millions, if not billions of dollars worth of products. If let's say, you sell a product that's worth, like let's say your total revenue is $1 billion. And then the year after that, deflation kicks in and you lose 5%. Basically what ends up happening is you only get 950 million from that same product. The thing is, those input costs that you had are relatively the same. So now you have to start doing layoffs and you have to actually take expenses out to make up for that difference. That's the problem. Deflation is bad. Disinflation is good, especially right now because we are going from high inflation to disinflation. So that's what we're trying to achieve.
Yeah. So I hope that answers your question. My opinion, I think the reason why cruise lines are hit pretty bad is because generally when there's a growth slowdown or when there's a recession, people travel less or they cancel vacation plans. In fact, I think I've heard like people talking about canceling vacation plans like 3 or 4 times a day. So that's usually the first to go when you're talking about people cutting budgets, getting ready for recession and so on. And those companies tend to see quite a bit of slowdown. What's interesting is actually booking.com is holding up pretty well. but that isn't directly related to offering the vacations or cruises and so on themselves. And actually, someone asked earlier, not in this pod, but somewhere else, but why is Grab dropping so much? I thought Grab is not reliant on the U.S. consumer and so on, because Grab's mobility segment for ride sharing and so on, a lot of their revenue comes in from tourists traveling from the airport. If that falls off a cliff, that's going to get hit. So understand that if there's a slowdown or recession in the US, I don't think anyone is safe or any company is safe. I think all companies are going to get impacted, but some companies might not get impacted as much as others. And you know what? I actually think about some companies might benefit, but generally speaking, most companies are going to be impacted. Most nations will be impacted. The US pretty much bringing the majority of the GDP around the entire world. The consumer is extremely important. If the consumer is weak in the US, that is going to highly impact the entire world as a whole. So that's the reason why if the US is a recession, there usually is some sort of global recession or global slowdown that follows. So that's where all of the fear is technically kicking in. And you saw China down 10% today, even though it's like, oh, China's outperforming the US, which, yeah, it's still outperforming the US. It's still up year to date. But the volatility of China markets is way more massive than US. Falling 10% in one day is a pretty crazy move. But when you think in context of the amount of money in China and the fact that a lot of China investments are not local, it's very easy for those funds to be pulled out and roll into US treasuries, which is what we've been seeing lately with the basically the bond market moving up. So yeah, hey Chris, I actually wanted to bring up this Bloomberg article, but I did not pay my subscription because I'm cheap. So do you have a Bloomberg subscription?
I am cheap also, so no, I don't have to get it.
Because there's this JP Morgan article on their forecast for recession. Did you see that in any of your news outlets that you have? Because I cannot seem to find.
Let me see JPM recession.
Damn, I used to have Bloomberg too. I didn't bother. It's so expensive. It was like $2 for a month for every month for 3 months, and then after that they jack it up like $60. It's like, dude, what?
Yeah, here it is.
Oh, you got it? Nice. Yeah, there's a recession coming up, so I definitely didn't want to pay for my Bloomberg subscription. All right.
So yeah,
here, I'll go ahead. Go ahead.
No, it's just I think a lot of this stuff is basically what they're doing is they're following the credit spreads, right? Like the credit spreads are what's scaring the shit out of people. And that's, I think, the impetus for the Fed to actually do some cutting. So when I mean the credit spreads, I created something that just makes it easier for everyone to understand.
That's good.
What happens with credit spreads? Okay, so this is high yield debt, option adjusted high yield debt versus the risk-free assets. So the treasuries are risk-free. Okay. So if you think about the spread between the two, the amount of return that you need in order to invest in a high yield debt instrument, you're basically going to need to get paid more because you're taking on more risk. The thing is, when it comes to companies that are high yield or junk, as they call it, is that they're impacted by recessions way more. Okay. Their business models could be a little bit shaky. The cost of capital for them is a little bit, more riskier. So imagine trying to lend to someone. Imagine right now we're about to go into a recession, and your nephew or your cousin's nephew calls, not because you have a cousin's nephew, your nephew calls, and he's not the greatest of borrowers, and he says, "Hey, can I borrow $100?" So if things are good and the economy is really good, and you're like, "Yeah, this guy could probably get a job and pay me back," you wouldn't mind lending it to him. But let's say you think that the economy is not doing good, and this guy is not exactly the greatest, repayer of debt. You're going to say to him, "Well, I need higher interest in order to make up for that risk that I'm taking on." So what this does is basically tell you the difference between those two things. So right now, the risk-free, if we're in the safe zone, which is less than 4%, which means, let's say if the Federal Reserve was issuing things at 3%, that means that the junk bond people, they would have to issue debt at 7, right? So right now we actually have our federal funds rate is 4%, which is the risk-free rate. That means that, the bond guys who are in junk status, they're paying about 8% to borrow money. If we start to feel like, hey, things are bad, and the economy is going down and these guys are going to be impacted more than anyone, you're going to say, hey, listen, I'm not going to lend you money at 6% over the Fed funds rate. I'm gonna need, like, let's say 10, which is what we had during COVID. That means that if the Fed funds rate is, let's say 4%, they're gonna ask for 14%. So that's when things get really bad. So right now we can see that we've actually been in a pretty safe zone right now where, companies at the junk level have been performing okay, but people are scared. And so now they're starting to demand more yield to compensate for that risk. And so if it goes into the danger zone, which we don't want it to go into the danger zone, because then what ends up happening is that's almost like guaranteeing a recession. So the bond market is very intelligent in trying to sniff these things out. I was not necessarily, and we spoke about this, we weren't worried about this because these spreads are actually tame. What we saw over the last literally 2 weeks is a huge spike in this. So let me just pull this up, credit spread. So if you look at this is the spike that we just got literally from January, it was 2.6 to now almost 4. Okay. 4 is it's starting to get into like warning zone mode.
Holy cow! I did not think that thing went up so quickly.
Yeah, dude. Today it was massive. And wait, no, it wasn't even today. This is from Thursday. So I wonder when the next release is. April 7th. So it's Monday. So we'll get this. Yeah, we'll get this, and this might actually be spiked up even more,
dude. Oh my goodness. I'm lucky to be hedged, but I wish I hedged more.
Yeah. Credit spreads are widening significantly.
That's bad. If you got, like Kris already explained what it was in a nutshell, when credit spreads widen, that shows that there's risk in the market, which means that there's a lot of money diving into insurance to not blow up. And this is not a market that retail can tap into. This is a highly institutional market. So when these things expand, it means that people are diving into, people are exiting junk bonds or high yield bonds, which constitutes for fear. So this means the big boys are getting scared.
So you can see here the last time it was around this level was around August of 24 when we had the whole Japanese yen carry trade blow up, right? And you can see that sometimes it spikes and it'll come back down again. The time before that was July of 2022. The question that we all have to ask ourselves is, like, is the Fed going to move if this thing keeps spiking up higher and higher? So if you look at this, you can see that the markets, they start to basically become a little bit more, what is it called? Dovish. Like the Fed can get a little bit more dovish and then bring things back down again, So if we start to see this go like closer to the danger zone, then you can see rate cuts starting to kind of imminently come in to basically support everything. This right here, this spike that you see in 2016 is what wiped me out. My first, this was like one major loss for me when this happened. And I'll explain it. I think I've told you guys before. It's because I had bought junk bonds for energy companies, and they did not do well during that time. So what's funny is, well, the thing is, if they had just survived, I would have been fine. Like, the problem is oil went down too much, and then it stayed down for too long. Otherwise, they're great assets, but that's the challenge when you invest in anything that's related to commodities. You're always going to have these, feast and famines. And then when the famine comes, you better be well capitalized, or you better get out the market and just stay out. So, but But I was a younger investor back then, so you know, it was
Yeah.
almost 10 years ago. So
Yeah, you know, I mean, just like seeing all this happen, I could see a lot of people are getting a little bit itchy thinking that, oh, look, Robinhood was at $70 and then now it's at like half the price. That means it's a good buy, right? Or maybe Hims was like $70 and now it's like 1/3 of the price. Good buy, right? It's like, no, that doesn't necessarily mean the case. These are very these are these are very high beta growth stocks. And when you see the market down mid single digits, it doesn't matter how good the company is, it's going to get sold. And JP Morgan got sold, and that's a safe haven. Visa got sold. That's it. Pretty much anything across the board got sold. There's very little green in the market, but everything got sold today. And actually, Google held it pretty well. I'm not going to lie, but Google dropped significantly initially. So I would say that this is not the type of market where you want to take big gambles for very short-term bets or go like extremely heavy. To be honest, this might be something that lasts for some time. So I would say if you're going to buy, like, don't try to call bottoms and go hard. Just take your time with it, because I called the bottom 15% up, 12% up from here, and I was dead wrong. But just didn't bet in terms of that. And I think the point of what I'm trying to say is, like, you just got to stay solvent, because once you go insolvent, you're out of the game. The goal right now is to not lose money, because like the market's down. Like, how can you not lose money unless you're short in the market or whatever? But the goal is to not blow up. And the way you don't blow up is by not trying to trade a VIX 40 market where you can just get chopped up to infinitum or stopped out if you're trading, especially.
yeah, don't do more right now. Leverage and margin are two things
I
should
don't use
not
any
do.
margin. I would not use any margin right now. And honestly, there's a lot of talk about selling puts. And guys, if you sold puts when you thought it was a good price, you're gonna be underwater on those, and you can roll forever if you'd like to. But at some point, when you're selling puts, you're most likely, unless it's a cash secured put, you're going to step into margin. And considering the economic scenario, at any point you could be margin called and they will close that for you at a loss. And then that's it. So be very careful of how you do this market. This is a very real scenario. This is not, hey, let's buy the dip scenario. All dips get bought. Like, this is, there are Wall Street analyst firms that are downgrading their forecasts every week. Ed Yardini downgraded his forecast from around 7,000 to now almost 6,000. Goldman Sachs downgraded the forecast significantly. Like, these firms don't do that because there's just a quick dip opportunity in the market. They do that because they see a material impact on the entire market. Even Dan Ives was bearish today. Okay. Yeah. And I'm not saying that he was he was fundamentally bearish. Dan Ives has been known as a very bullish AI tech analyst. Today, he was not that on the US spectrum. He was saying things like US basically might not be the leader that it's supposed to be for tech, and that he was just saying as it is. Like, he wasn't sugarcoating. He was saying, like, Trump is doing I don't want to say irresponsible, but Trump is doing something that could have erroneous effects on the market and the economy, and no one knows what's going to happen.
Yeah. On the lighter side of things, because we really do need lighter side of things.
Yeah.
Let's watch this one clip. I think this is actually what we should be thinking of as investors, especially if you have dry powder.
Investors aren't really expecting today. So the S&P, this I've been updating this table very quickly the last few days because every half hour it seems the declines seem to deepen, but it's a 15% pullback now. We tend to see that almost every other year on average. We saw back in 2018 an even bigger decline. It's hard to imagine that, on the same reason, tariffs and trade wars. And so the question would be, could this be another bear market? And the answer should be, of course it could be. But longer term, if you're a longer term investor, you should be looking at this spike in volatility as an opportunity, because when we see the VIX spike to these kinds of levels historically, what do we see following that? We tend to see better than average future returns. So we had the VIX this morning above 40, very rare that it gets in that type of scenario. And you tend to see better returns. And I'm showing you here, what if we have an absolute collapse today or next week? Well, these are the returns, Peter, following the worst weekly closes for the VIX historically. You can see a lot of green in that. And people should be looking not at the 1-year returns, which are all positive, but really the 5-year returns where the S&P 500 doubled in all of these cases.
Yeah, I mean, this is for those only listening. I mean, the 1, 2, 3, 4, 5 year in every single time in all of history where the VIX has behaved this way is positive. I mean, it's just an incredible chart.
And these were the absolute worst moments, even in today, March 2020 and October, November 2008, March 2009, right? These were absolute crises where the fears were even worse and the uncertainty was even worse today, and the market found a way to go higher. And I'll just end with sentiment here, Peter, because last year, mostly we were talking about the opposite of this, where people were exceedingly bullish and the market was hitting all-time highs pretty much every week. Well, now we have the highest bearish sentiment that we've seen since March 2009 in this individual investor poll. It's actually only been higher 2 times. That was in March 2009 in the week during the low, and October 1990. Some of the listeners might remember that was a bear market and recession. That was also at the week of a low. So no predictions here, but much better to be investing in a period where other investors are bearish and there's a lot of fear in the market than the opposite. So this is, we talk about signal or noise, is a much better signal when you see this type of fear going on in the market. And we'll end here with a chart showing you what happens typically during drawdowns. And this is an important point because people think that drawdown is only going to weaken. But Peter, historically, what has happened during this type of 15% drawdown?
We know that the 1, 3, 5, 10, 20 year, all above expectations, all above historical norms, double digits across the board, triple digits over the long run. Drawdowns are a disciplined investor's best friend. This is why you get paid more to own stocks than bonds. Stick with it. And if the opportunities get more significant, maybe lean into it.
Well said. All right. Thanks everyone for joining us on this special.
So that guy, he was actually in the Compound and Friends during their Future Proof live interview. I forget his name, but Charlie Biledo, I follow him. Yeah. He's really good. I watched that every few times as much as I could. No, I mean that's very sound, but I'm trying to tell people, like, dude, you just got to be smart with your money, right? You don't want to become insolvent because nothing says that history has to repeat itself. I'm not saying go ahead and go all in puts or liquidate your portfolio. I'm just saying, you don't need to go all in. If you want to do bigger tranches, go ahead. But if you go all in and if you go all in with the assumption that you caught the bottom, that's a different story versus like going all in, just like it is what it is, sort of. Going all in, assuming that you caught the bottom, is a recipe for disaster. Like every buy you make, just assume that it's going to go lower. So that way you're ready to buy more if it does go lower. And if you don't have like an account where you constantly adding to, then you just have to just bite the bullet. If that's the case, like if you're going to make your last buy, then go ahead and make your last buy and just bite the bullet. But like once you do that buy, unless you're like a trader or a short-term swing or whatever, like, if you're accrediting this to a much longer term mindset of multiple years, then look at that chart. All right. And keep that in mind. And then hopefully we're another green one. But like, at the same time, like keep in mind that it could go lower and that could not be true. Right. Because I just very cautious out there to guys who are selling puts and whatever. Just be careful, guys.
Were you buying anything today?
Yeah, today actually were my biggest buys that I made so far. I just said, guys, be careful. Yeah, today I made the most buys. But I made a good amount of buys today, and full discretionary. I have a few percentages of cash left, and I deposit money into my account very often on a routine basis. So I'm very fortunate to have that. But the companies that I've been buying a lot of have been mostly centered around mega cap or like profitable companies with a business model where they could easily survive this scenario. Okay. And that's Amazon, ServiceNow, that's a very profitable SaaS company. It's a large market cap, but it's pretty much a staple and like zero competition. Google, of course, have no problem buying Google. I bought Mercado Libre. And then on the smaller side, I bought some Hood. Cloudflare, which is technically not a profitable company, but like they don't really have any competition when it comes to cloud. Anyways, I concentrated most of my buys in like mega cap and companies that have a very solid moat and leaders in their industry. I have not added to speculative companies. Like I haven't added to Nebius, even though I'm very bullish on Nebius. I haven't added to ASTS. I have not added to Unity. I haven't added to AppLovin. I haven't added to Reddit. I, in fact, actually cut my AppLovin position in half when it was at like 290, and I hedged it too. So because of the fact that that short report was very suspect, I actually went over that short report, I think in the last show, and it was very suspect. And, you know, Reddit, it wasn't that big of a position, but I decided to cut the position in half a few days ago, and I got lucky, right? And I also got out of pretty much all of my spreads the other day. Yeah. And I'm in shares. And I think I've said in the beginning of the year is that I've switched mostly to shares. But the other day, I'm like, I'm just going to shares now. I don't know how this is going to turn out. And the beta in my portfolio is going to be too massive if this continues. So I'm still in, I'm still invested. I just did not want that beta in my portfolio. And the beta has dramatically dropped since then, especially with the hedging as well. But certainly having the TLT leaps did help. I actually sold calls against some of my TLT leaps. So I guess I should have done a little bit earlier than I did because TLT dropped like a whole point when I did it, and then it bounced. So like, we'll see. How am I hedging? I actually, I targeted certain hedging, especially hedging my positions. I played puts on NVIDIA and overnight into today, and that paid off very well. And they were like out of the money calls for April 17. And dude, those things went up so much, you know, and I played puts on 470 for Amazon. I played puts for Tesla when it was around 260, and then I exited those. I played puts on Hood, Palantir, and so on. And the point of hedging is not to be green on the next day. It's to utilize your cash position to quote unquote hedge your portfolio or to lessen the blow or lighten the blow on your portfolio. But even though the VIX was like mid 20s around the time, the puts were actually expensive, but I didn't buy a lot of it. But when the market's down 5%, they help. Yeah. They certainly help, especially with a lot of high beta stocks, and also keeping an eye on like certain companies that were supposedly holding strong the other day, like Palantir and Tesla. Like those were holding very strong the other day, and I saw the data and I saw what was coming. I'm just like, let me just buy like out of the money puts like very cheap, right? And they went up a lot, you know. But dude, I'm down a lot too. Like I don't think there's any hiding from it. Right? Like, did you?
Bro, I'm down. I told my wife how much I was down today.
Yeah,
I was like,
dude, it's no joke. It's no joke.
What I did was I had a little bit of cash that was like not related to my house money and my tax payment money. I took that and put it into the market and just bought Venture Global on all my portfolios because I was like,
yeah,
this is just. And they actually released some of the data that they had with how many cargoes that they actually shipped and what pricing they got for it. So they're going to come in above their original estimates. And with the stock price being where it is, it's like from a capital allocation standpoint, bro, it just makes too much sense to buy back shares at this price. And they've got the liquidity to do it. So I'm not worried about it. So at 740, this thing is like a steal, especially because I'm going to hold this for like the next 10 years. Because this is literally, to me, this is like another Cheniere in the making. and it's actually going to surpass Cheniere in total production eventually. So, you know, I don't mind buying as much as I can of this thing. They have a great business model that doesn't necessarily get impacted by commodity prices as much. They do have exposure because they do sell on the spot market, versus like Cheniere, who does more like contracted cargoes. These guys do contracted cargoes also, but they also have a significant amount of their profitability coming from right now, at least coming from spot. And spot is holding up okay. So let me just share a chart with everyone.
Yeah, I just gotta say, I haven't really been buying a whole lot of VG, and I should be. But you guys know that so much more than I do. Next, I'm actually looking to maybe add to that, but you told me earlier maybe I should do more VG. So I need to like definitely look into that this weekend, because I know you guys are very bullish in that one.
Yeah. Me and Matt.
Are you sharing your screen?
I'm about to. I'm just pulling up my dashboard.
Let me try to look for that Cash Flow Chronicles episode you did, and I'll post a link in here in case anybody wants to watch that one.
Yeah. Damn it. Let me see. Henry Hub. TTF.
It's crazy how with Next, how much it like pulled back. I mean, I did not see a 20% drawdown coming today. That was not in the cards.
It's because it's oil and natural gas, man. Everything is indexed right now, so everything is.
No, I know it got thrown out the window.
Yeah, you know. So let me just share the screen with everyone. Share content. Share window. Okay, here it is. So this is the price for Henry Hub versus JKM and TTF. This is what dictates. Yeah.
Okay.
This is what dictates the price between. This is basically the spread on natural gas. Okay, so natural gas gets this blue line right here is what the U.S. what it costs us here to produce this natural gas. Well, not produce, but basically what it's trading at, and then what the current landed cost is in Europe and in Asia. So this spread is where these natural gas companies or these LNG exporters, they make their money. So you can see here that the price of let me just actually.
Oh, someone asked if you could zoom in.
Yeah. So you can see here that there's a spread that happens between the two, and this is the money that these companies end up making. So if you can get natural gas for $3.84, super chill it, liquefy it, send it to Europe, and sell it to them for $13. Well, this is Japan. So if you can sell it to Japan for $13, you're basically going to be making a $9 spread in between the two. Now, of course, I'm just being very simple about it. There's actually other costs. There's liquefaction costs, which is what this company Venture Global does and makes money. So they charge a fixed fee for that. And then there's shipping and regasification, which is like another $1 or $2. So basically, the spread between these two is how people make money in this sector. These guys have let me just actually take Japan away and just put the Europe. So Europeans, they typically get they used to get a lot of their natural gas from the Russians. And now, of course, the Russians are not doing it. So the spread has basically opened up. And now they compete with the Japanese and the South Koreans and the Chinese. But the Chinese have kind of pulled back a little bit too. So, you know, they don't necessarily have as much competition. But this spread is what is going to dictate the profitability of these companies going into the future. Some of these things they can lock in by doing like forward contracts. And so, you know, they can make more money that way. But you can see here that the spread sometimes gets super wide. So at one point, Henry Hub was trading at $3.52, while at the same time in Europe, the natural gas landing was about $17. So look at that crazy spread between the two that you could end up making. So I'm telling you, that freaking natural gas, man, it really is the widowmaker. And then sometimes the spread can close and actually not be very good either. So you can see here, like the spread here closed between $2 and $7. So the cost would actually not be as good. You know, because if you buy it in US for $2 and you can only sell in Europe for $7, that means the spread between the two is only $5. You know, and if you factor in liquefaction costs and transportation, you're basically not making that much money. You're making what, like probably like maybe a couple of dollars per cargo. I mean, not a couple of dollars, a couple of dollars per MMBTU. Right now, you're making about 7 to 8, and so this company Venture Global takes advantage of this whole thing, and and basically makes its money. So yeah.
Yeah, I mean, I agree with what Ray's saying. I hope we're all laughing about how cheap things got today.
Yeah.
This is the tough part. This is literally the toughest part. Well, one, not have enough money is probably the biggest tough part. But two is that some of these valuations today have gotten, I don't want to say absurd because this is based on previous earnings. So these earnings can actually get worse. And if that happens, then things aren't as cheap as they look like they are, right? So if Amazon's trading at a PE of, I don't know, Google's trading at a PE of like probably like 1 right now, right? Realistically, probably like 18 or 19 or something.
Mm-hmm.
Well, they're buying back shares. That's a pretty bad example. But if they have a terrible year, so 4 quarters in a row of terrible earnings, right? Then that PE could be elevated with, even though the stock price goes down. And the inverse is true too, right? I'm not. It isn't a good example because it's Google, but I'm saying that if you think of valuation, it's always measured historically, but the historic valuation doesn't have to repeat. Like we could literally be in a sideways situation for like 3 years, like Goldman Sachs said, or we'll be laughing about this in a year as soon as that. So, that's just the risk of the entire market. But I hate looking at my watch list. I'm just like, dude, some of these prices are just, I would have never expected these prices today. Like I'm looking at, here, let me actually share my screen, my trading view real quick.
Yeah.
Man, I'm just like looking at some of this stuff. I'm like, wow, VG's down. I'm just, wow. Like, I don't know, man. I did not see that coming.
Right. I cannot wait to finish my goddamn tax. Like, I want to call my accountant and be like, hey, man, what's going on? Like, how much do I owe?
Man, just go on margin.
Huh?
Just go on margin.
No, I'm not. I ain't doing no margin.
I know.
The wife
like,
would kill me, dude. So no, I'm just gonna, like I said, wait it out. Once the taxes are done, whatever excess capital I have left, I already told her, I was like, listen, I'm dumping this into the market. Like, I know that we want to buy a house, but right now, let's just take advantage.
Dude,
let's just take
look
advantage.
at this. AMD's 85. 85. The 2022 low was in 60. That's not
Bro,
that far from
look at
here.
Trade Desk. Look at Trade Desk.
Trade
That's
is
the
in
one.
the 40s, dude. In the 40s. Like some of these prices are pretty wild. I haven't added to Trade Desk. I still have a position. Like, so, I'm not like going all in.
It's
but
absolutely insane that these guys are trading at this level, considering
how much
how much they've actually improved since then.
Yeah. Oh, IBKR. Actually, I used to own IBKR and obviously sold way too soon. I mean, IBKR, like there will always be traders out there. This is like a staple platform for a lot of international users, even US users, because the amount of markets you can invest in IBKR is just, it's crazy. Like how much capability, but their UI is just crap. But anyways, I found this interesting. Shopify is in 76, but if we go into recession, it's gonna be way worse. Nubank hit the nines today. I added a little bit to Nubank today. But yeah, some of these prices. Wow, Disney's back at 83. I mean, I'm not touching this, but I didn't think we were going to see this low again in Disney. What's Royal Caribbean? Of course, this thing like is not even impacted. This stupid Royal Caribbean, man. You all say what else is new, Matt? What else is new? I saw this one today. This is pretty interesting. SLG.
Yo, those Brookfields are holding up okay. They're not immune to this, but they're okay. Someone asked a question about that BPYPM.
Where? I don't see it.
You don't have it on there. Just I don't know if these guys have that because it's a preferred equity. So
Oh yeah, I don't really want to get into that one. Let's
yeah,
leave that for the Patreon. This is actually very interesting. I found this one interesting.
yeah.
The end. Like, I don't have enough money, man. I don't have enough money to buy all this stuff. But one thing that I found actually pretty interesting is that TFC is back down to
To 34.
almost
All the
30s.
regional banks are
Yeah,
down.
KRE is getting killed. Yeah, KRE is getting killed. You don't see this type of stuff, guys, too often. But at the same time, don't dive in thinking you're to call the bottom, because the bottom could be more bottom. Of course, this isn't going anywhere. You know, I'm like waiting for this one to go back down. I remember when Visa, they had that little drop over here in July. I was thinking about buying Visa, and then I didn't. And kind of fortunate I did not. And then, of course, there's the Mad Dog in the Kingdom. Probably had its first really bad day in a long time. This chart is just up to the right. This guy's sitting on a monster amount of cash. Yeah, don't
he's gonna
load
deploy
all
it,
at once. Yeah, man.
All right, brother. I'm gonna go to sleep.
I know. That's it. That's it.
That's the best place to hide, is in your dreams.
Wait. Did someone say that, or you just made that up?
No, I just made that up. You know.
Okay.
Yeah.
No, you're not. You can't hide your dreams, dude. You can't hide your dreams, because you know your dreams are gonna be like Trump's gonna be in your dreams. He's gonna haunt your dreams.
That freaking guy, man. All he has to do. You want to know something? If he just went with the Bassett plan, he would have been fine. Like the markets would have been okay. The fucking 10% tariffs, but the market would have just shrugged it off. And you did see it shrug it off. But he had to go with the Lutnick fucking plan and just go insane. It's like, whatever. This is what we deal with. Thank you. Kris is going to dream of VG at $100. Yes, I will.
That would be actually very interesting. That would be very.
Believe it or not, it's actually a lot more doable than people think. If right now the current market cap is 18 billion, okay, which means that and they're going to generate 7.1 billion in EBITDA according to their projections this year. So if they do 7.1 EBITDA, 10 multiple on it, 70 billion, they got 29 billion in debt. So that's $40 billion in market cap. Okay, so that means that it's $40 billion in market cap. They got 2.4 billion in outstanding shares, fully diluted. That ends up yielding about $17-18 per share. Now here's the kicker: they have about, based on my rough estimates, about 5 to 7 billion in cash at the end of this quarter. Right, from both earnings this quarter that's coming up, and then the IPO, and then the cash already on hand. You know, they'll spend some of it on capex, of course, and some on interest, but most of it, like I said, they can do about a $2 to $3 billion buyback, especially if they do it at this undervaluation at $7, $8, maybe even $9. They can take out about 240 billion this year and 240 million shares this year, and maybe another 100 something million shares next year if the price goes up, which means that they could be looking at about 2 billion in shares outstanding. And all you have to do is just keep doing that over and over and over for the next 5 to 10 years. Their production is going to be going higher and higher. This is going to be like this is the one to be in, because all they're really doing is just building these things. These are floating. These are going to be ATMs that print cash. They're going to be able to utilize that cash, some of it to pay down debt, some of it to basically, buy back shares. And then you can see like a giant move to the other side, so.
All right. That is it tonight, guys. Thank you very much for coming on. Talk to you guys later.
Take care, guys. Have a good one.